Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. At a time when Trump and his tariffs is spooking the market, the question is, should we really be worried about this? Is this going to be a long-term correction, maybe even a crash of the market, or is it something that will settle down once the tariffs are clear? To discuss these issues, we've got Adam Dawes of Shaw & Partners, and we'll be looking at the stocks he would buy if he's a defensive player, or the stocks he'd buy if he was a growth player. And then Paul Rickard will look at the same kinds of subjects, and we'll also have a look at the impact of the Aussie election. When will it be, and what kind of impact is it having, or will it have on the market? So without any further ado, let's cross now to Adam Dawes of Shaw & Partners. Thanks for joining us, Adam.
It's great to be here, Peter. Thanks so much.
Okay, there's three big areas I want to tackle with you. One is how you're generally playing the Trump tariffs with your clients. And, obviously it's the way you think about this market interruption from his unusual policies. And then if you're a defensive, nervous investor, what stocks would you be pouncing on right now? But if you're a buying opportunity, seeing this as a buying opportunity type investor, what stocks would you waiting to pounce on when you think the time is right? And I'll ask you, when will the time be right? So they're all pretty easy questions. Let's start with the first one, you and Trump tariffs.
Yeah, look, it's certainly something that over the last 2 weeks has really gripped the market, and that's uncertainty, and that's certainly fear. Fear and greed are the two biggest emotions that run our market, and certainly fear has been the one that has really gripped our market. And certainly on Friday, I think we saw somewhat of a capitulation. I don't know if it's a full capitulation, but going below that 8,000 level for the ASX 200 definitely showed that there was a lot of nervousness out there. So how do you play that? How do you play that nervousness side of things? And I think we'll get to the defensive side in a second, because I think that's potentially how you play it. But, we've been talking to a lot of investors about how to play Trump and the uncertainties, and certainly looking for businesses that are very much America-centric, businesses that are producing. So something like a BlueScope Steel, James Hardie still struggling, but that's not a bad idea. Worley is another one that has been undervalued for many, many years. And even with drill, baby drill from Trump, I do think that oil and gas engineering is certainly something that's going to continue and lift as well. So I think there's a couple of ways that you can play it. I stepped into PolyNovo the other day due to the fact that they do have a lot of that American-centric production. Got my fingers burnt a little bit on the downside on that one, but I still think that in something in the healthcare sector, certainly CSL and ResMed are two companies that have produced a lot in the US. And I think something like a BlueScope, you've got to be mindful of how much production's in the US, and that is one way to play that America first side of things. But the problem is that every time the tariffs arrive, next week they're off again. So it is very hard for an investor. It's very hard for people like yourself and I, Peter, who try and give advice to clients on which way to go.
So let's just look at the whole Trump threat as from the big picture side. Do you think this is a short-term pullback / correction, and the market will eventually get not necessarily relaxed, but they accept what the new lie of the land is, and then they start concentrating on the fact that interest rates are falling, US is not in a recession, even though there's question marks over that. Artificial intelligence is going to really change the bottom line of so many businesses. Putting all those together will be reasons for an eventual buyback of this market, given the fact that these tariffs aren't necessarily as economically impactful as some people think.
I think I agree. However, I think the problem is that every time we've seen weakness previously in our market, it's been met with a lot of buying, a lot of strength. A lot of people have say buy the dips, and then it's rallied back up really, really quickly. I think this time might be a little bit different. We're a little bit gun shy. We've been beaten around the head a couple of times, and I just don't know if that extra money that would normally come into this market to support it under that 8,000 level for the ASX 200 would then be bought up really, really quickly. So I think the problem is that, yes, there is still confidence there, and there's confidence in certain sectors, But over an entire market, I think everybody is a little bit gun shy, and we haven't seen that force of money coming back in to bring this market back up, which shows to me that people are nervous about what's
Yeah.
on the horizon.
Okay, I'm going to back you into a corner because I haven't seen you play both sides of the street for a long, long time, Adam. So you back you into the corner.
Thank you.
End of this year, is our market up from where we are today?
I think we will be higher at the end of this year. I think, if this is our correction, which we're getting close to, this is our correction that we had to have, then yeah, absolutely. But I do feel at the end of this year we will be higher. And I think 2026, 27 gets a little bit more murky, but I am confident with interest rates, as you said, a lot of these economic factors that are pushing through, we will end the year higher. But it's great opportunity down here, and it's hard when you're losing money or you're seeing red on the blood on the streets to put more money in, and that's where we're at the moment. But I do feel we'll be higher at the end of the year.
Okay, ladies and gentlemen, I have backed him to the corner, and he has actually said what I expected him to say,
Yeah.
that the markets will be higher, but it was just a bit of pressure in between. Okay, let's go to the other big area. Okay, I am a defensive player. I don't care whether you're right or whether Switzer's right. I just want to go defensive now. I made a lot of money listening to Dawes and Switzer and Junbei Liu and Paul Rico over the last couple of years. I want to bank that money by being defensive. So what stocks are going to be safe harbors over the next year or two? Okay, I accept I'm not going to make big money, but I'm happy to get dividends. I'm happy to see the market just creep up a bit. And if the market goes off, I won't lose too much because, well, these stocks do pretty well in a down market.
Yeah, so I've got three really good defensive names, and certainly three or two of them have done very, very well so far. But Amcor, again, very defensive business, got a lot of money in this one. Happy to be there. It is somewhat of a growth story in China and through the sort of the emerging market side of things. But certainly, I think Amcor is one of those ones. The second one is Telstra, reported really, really well. The dividend was actually not too bad, and this company is turning a corner, and it is coming to its own in that defensive side of things. But my number one pick in the defensive space is APA, Australian Pipeline Trust. They came out to the market. They said they don't need to raise any money. They might need to sell a couple of assets, but however, they are connecting the East Coast gas line, and that is going to bring a lot of new gas into that market, and it'll be an essential pipeline for them to grow that area. So I think APA is probably my number one pick for a defensive stock in this market.
Just throw two more in for your consideration. Coles and Woolworths. Look, they've been beaten up. I know the analysts quite like them. Are they all? If you wanted to have 5 defensive stocks, would you give them a run?
Yeah, look, Coles has actually been stripping out Woolies like for like sales for the last sort of 6 quarters or so, 5 quarters. Coles has actually been doing really, really well. I think Woolies is probably a better business as a whole as far as diversification and the more value that you can see in Woolies, because it hasn't run as hard as Coles has, going forward. So I definitely think Woolies is a place where you can be quite defensive. Everybody still needs to eat bread, milk, and cheese. And for that, I think the basket sizes are going to get larger if you're not going out to restaurants anymore. Basket sizes are going to stay there. So Woolies would be my pick. However, Coles has been able to do it over the last sort of 5 quarters on that like-for-like sales. So if you hold Coles, keep holding it. But if you're looking for that consumer staple sector, I'd say Woolworths is a buy.
Okay, let's go growth. The kind of plays that you might not necessarily do right now, and I wouldn't be buying now, even though I think the sell-off is a buying opportunity. But when you feel as though, okay, there's certainty, Trump has nominated what he's going to do, the country's affected, nominate what they're going to do back to America. Okay, we know what's going on. What would you buy? What would you buy?
So in the industrial side of things, I think Brambles is probably one of those ones which has actually done really, really well.
Yeah,
but if we do get a really sort of a better look from the international consumer side of things, Brambles is one of those businesses that will continue to move higher. So that's probably one of the better ones out there. One of the ones that I reported quite well was Fleetwood, the mining services business. This is actually one of their best reporting seasons so far. So I think that is looking really, really good as a growth side of things. And if you really want to play something that's, totally could go either way is WiseTech. It's sitting around that 90, 89 level. It is an amazing growth story. It's just got lots of problems. But I do feel if the market does turn and we can get the directors and we can get that governance right, this thing's going to go back over 100 plus. And I think WiseTech is one of those growth stories that you could definitely look at.
Yeah, if we just get Richard to behave.
I was being political when I said.
Look. He's an extraordinary performer, business-wise. His private life has affected the company and shareholders. So, he doesn't get off scot-free, but I'm also recognising he's a human being, and human beings make mistakes. But the bottom line is the analysts really do like WiseTech. It's an example of a quality company beaten up. And if there is going to be growth, I suspect WiseTech will show that. But it's a gamble, as you made the point. It could go lower because who knows what might come from left field, particularly when the media is after a CEO. But you're right. I think it's a very interesting company. Just before you go, when people have asked me, I've thrown in companies like Zip, NextDC, and Xero as companies. If they want to sell them off now, I think they will be gainers in the future. What do you say?
Yeah, definitely. I think Zip under $2. I think that looks really, really attractive and something that, as a business, it is geared to the US recovery. And certainly, if the consumer, which we know the consumer in the US is very resilient, Zip is certainly something that you can definitely do. Xero, I'm probably holding back on a little bit. It's done well and it's held up well, so that's something that I'm comfortable with, but I wouldn't be selling it. There's no doubt about that. 360 Live 360 looking really good as well, and that is a growth story in clients' portfolios as well. So look, there's a couple out there, and there's a nice little trade going at the moment. JLG, John Lynn's group.
Yeah.
Which is all the disasters up in Queensland. They're going to take advantage of those strata side of things. There's a little trade in that one, which is unfolding at the moment. So there's some good stuff out there at the moment. Yeah.
LG copped it a few weeks ago because its American business wasn't showing any potential, but along comes Tropical Cyclone Alfred, and then things change.
Yeah, we're back in. Yeah.
All right, mate. Thanks for joining us.
Great to be here. Thank you.
And that was Adam Dawes of Shaw and Partners. Now let's go to Paul Rickard of the Switzer report to see how he's playing the Trump tariff traumas. Well, thanks for joining us, Paul.
Thanks, Peter.
Before we start talking about Trump, and clearly a lot of people are worried about Trump, I know a lot of our financial planning clients are wondering how serious this sell-off is. Why don't we just start with the failure to go ahead with the expected date of the election. Is an election question mark having a negative effect on the market, do you think?
I don't think it has had much of an impact yet, Pete. I mean, I think that's perhaps to come.
Yeah.
Generally, elections are not good for markets. Markets don't like uncertainty. So market finds it hard to rally during sort of that electoral period. And then obviously looks at the result and decides what it's going to do afterwards. So I don't really think that's been a factor, but now we're going to have another couple of RBA board meetings, maybe talk of an interest rate cut. And I guess an election sometime the 12th or the 19th of May look like to be the dates.
You throw all those things together, election gets done and dusted. Obviously, it can be May 17 now, likely.
I think so. Is it not? Yeah.
It seems highly likely.
Yeah.
And then if we get a rate cut in early May, so you got 2 rate cuts, you got certainty around election. The next question is, well, Trump. Will the Trump tariff drama eventually dissipate, do you think?
That's really the $64 question. Just before I go on, I'm not sure the RBA will cut in May.
Don't you worry about that. They will.
Right in the middle of an election campain, but let's see how that plays out.
Yeah.
They may need to, but look.
Let's assume you could be right.
Yeah.
Okay.
Well, that's a bit like a $64 question. I think America's going to settle down, and Trump, I won't say will settle down, but America will get a bit used to dealing with some of his policies and what he's doing.
Yeah, big bag of curveballs.
A big bag of curveballs. I think in the short term, we're not going to see that settling down. Yeah. Now, they've got a couple of interesting things to go through. One of the things that Trump's going to have to negotiate is the current budget funding that runs out, I think, at the end of this month. They're going to talk about deferring that another 6 months through some sort of deal.
Yeah.
But that whole question about how big can the American deficit be, the arguments with sort of some of the hardliners in the Republican Party, all that's got to come out. So, and that might actually put a bit of a handbrake on him to some of the things he wants to do. But at the moment, there's not a lot of resistance. I think we've got to see, he might, the impact on the market itself, and maybe whether he does throw the economy into a bit of a, I won't say the R word, but there is a bit of talk about the American economy slowing rapidly, and that might be the handbrake he needs.
Yeah, so clearly we have to watch inflation. Is inflation coming down so it's not sticky? We also have to look at whether the economy is going into recession. These are all question mark curveballs, and it explains why the market's a bit jumpy now. But tariffs probably is the main trigger, isn't it? Because as soon as you go serious about it, the market sold off. But Paul, the actual economic impact of these tariffs have been slightly exaggerated, I think.
Yeah, I think there are very mixed reports about what the impact's going to be, and whether it's going to tariff everything or just some things, and country by country, and what it's actually going to do. I mean, it's going to take time too, right? Like these things don't immediately change supply and demand overnight. It has an impact. So, but it takes a while. So it's got to filter through the system. I think we're going to go through the tariff phase and then move on to something else. I think that's sort of probably got a little longer to run, but and then the market will get a little bit worried about some of these other.
Okay, well, let's assume you're not buying stocks right now, but do you think there's going to be a time in the future where you say, right, some really good stocks have been sold off, it's now buy time? And I think people will do that eventually.
Yeah, I think it's probably a little premature, but yes, I do. I mean, I still think if you look at the next 3 or 4 years, the US market will be higher today at the end of his term than it is today. That would be my deep down view. And probably by the end of the year. But I think we do have a little bit of bumpiness, and we need to get. I'm assuming he's going to be somewhat rational in all this process. That's a big call to make.
Big call.
But let's assume that his deregulatory agenda and other things will ultimately be good for US company profits.
Yeah.
The stock market should be high. That's what the stock market's all about.
Yeah.
And that's what the Republican side and the people who voted for him believe. So he's got to get there yet. But I think, the markets itself could well be the handbrake he needs, right?
Yeah. So we've got, I think, rate cuts, artificial intelligence. As a Goldman Sachs CEO said exactly the same, artificial intelligence is really going to help a lot of American companies. And you're right, deregulation. You might find the tax cuts hard with the budget really big, but still, I think you'll talk a tax cut game.
You'll talk a tax cut game.
Yeah. So they're the kind of things that make me think there'll be a bounce back as well. And I'll be looking for an opportunity to buy. But for those people who are nervous and want to play defensive, Paul, in Australian terms, what would you be going for?
Well, the only trouble with defensive stocks, Pete, they're great in a market that's going south. They don't always go up. No. But look, I still think there's value in Telstra. It's rallied 10% since, if you add the dividend back in, it's rallied 10% since it reported. That was one of my tips for the year.
Yep.
I like Telstra, not because it's anything magic about the company, but it's basically a big monopoly.
Yeah, the drivers are ordinary.
Rivals are fairly ordinary, and it's now sort of increasing earnings a little bit, and it has a fair bit of market power. And as long as it doesn't do anything too stupid, it can deliver a reasonably good income for investors. So that's Telstra. I think there's a bit of value starting to creep into Woolworths, and I've written about Woolworths versus Coles today. Woolworths used to be traded at a big premium over Coles, and that's pretty typical because market leaders traded a big premium over the number two.
Combank versus
the major banks. Yeah. Other major banks, look at, for example, REA versus Domain.
Yep.
And Woolworths always had that over Coles. And the reason why Woolworths had the premium, it was the market leader because it was the biggest, it had the best stores, and had the highest margin. It was expected the margin was a lot higher than Coles. Now, a lot of that's changed. Over the last couple of years, Woolworths lost its way a little bit, you could say. The margins come under pressure, got a lot of trouble with the regulator and the public, has to give some back in terms of be a bit more transparent in some of its pricing policies. and then had its own industrial action and over Christmas, and a lot of things fell off at once.
Yep.
New CEO, new broom. Markets come back and they're basically trading pretty much line ball.
Yep.
And I think that the leadership will come back to Woolworths. And so I think that's, I'm not saying Woolworths is out of all its problems. You know, we've got an ACCC report been given to the government. It'll probably come down fairly hard. Whether
for election reasons.
For election reasons, whether that affects Woolworths more than Coles, I'm not sure. And I think Woolworths has got a bit, in the short term, get a bit of consumer trust going again. So it's probably being a bit more.
And what about the dividends at Woolworths and Coles? Are they getting respectable again?
Look, they're okay. Woolworths is about 3%, maybe going to 3.5%. Coles is about 3.5%, going to 4%. It's okay.
Okay.
So there's some defensive stocks.
Okay.
I think stocks like some of the infrastructure type stocks like Transurban is a pretty defensive stock. People are going to use toll roads if the market falls. You know, you can argue that things like APA is pretty defensive. Maybe some of the property companies, not Goodman, but some of the property trusts are defensive.
Would you go into some of the income funds, you know, like VHY and stuff like that? You're going to lose capital, but you get income.
Yeah, I mean, the problem with a stock like VHY, Pete, which is, of course, it's a Vanguard, it's an index fund that basically looks at the higher income stocks, is that dividends across the market are falling a little bit, not rising. And that's mainly because of what's going on in the resource sector.
Yeah.
That's your BHP and your Rio. So, look, I think that's probably okay. I think there's some others. I mean, some of the stocks that really haven't rallied much will do okay. I mean, the bit of the markets that probably most exposed are companies like Macquarie, although it's had quite a big fall the last week or so. I think the banks are probably overpriced, and most of the other leaders will go with them too, simply because if the market gets a bit bearish, that's what gets sold first. It's also the bit that rallies the hardest when the market sits at the bottom, but it's the bit that gets knocked down.
If you're a growth investor and not worried about Trump and think that there will be a bounce back, what kind of growth companies would you be buying? Not necessarily now, but in a few weeks' time, if you think the Trump thing is sort of.
I mean, I'd be look at some of the medical companies. Maybe a CSL if it gets knocked down. Cochlear is starting to look a bit more interesting again. I'm not sure I'd be rushed straight into the tech companies just yet. I mean, I'd like to throw the question over to you. You give me what your thoughts on.
Yeah, I had a look today. I was actually surprised that the analyst view on both Coles and Woolworths very positive, and quite big gains were possible. I think Xero is always a great tech company to buy. I think NextDC is probably been hit down a lot, so therefore it looks like it fits into my quality company beaten up by the market. If I thought the problems with Trump were more long term, I wouldn't be worried about chasing tech, but I think it is going to be more short term. And I quite like the other tech company is of a big kind. Is or Zip. Zip and Block probably will do well. I don't think Trump will allow the American consumer to go running away and they're making money. So those sorts of ones I'll be looking for maybe in 2 or 3 weeks' time, if the whole tariff thing is sorted out. If it's 2 or 3 months' time, well then, but I think they will bounce back.
Yeah, I think he's got a bit of I mean, I'm surprised by how quickly the US market's gone to talk about a recession, right?
Oh.
And I think that's all a little bit premature. I think what we're seeing in the States is, people are just a little bit nervous because his policies and the way he delivers them are quite radical. And to say the least,
completely unusual.
And you've got a lot of public servants potentially looking for a job, or maybe looking for a job that causes its own uncertainty. So you've got to have it's sort of his shake up, and he admits it himself.
He's a bit like Taylor Swift. He's shaking it up, isn't he?
I forget the word he uses. Not pain, but there might be a little adjustment. He calls it, right? So
he did promise to drain the swamp.
Drain the swamp, right? That has an impact. So I think we're always due for a correction, Pete. I think we're sort of in it, but I think tariffs is what's driving it. I think the market's going to want to see this sort of all settle down a little bit, get his tariffs on, then focus on something else. Take some of the politics out of the, I won't say out of the agenda, but just tone
I'm looking forward to
take
seeing
the
that.
temperature down a little bit in terms of what's going on.
Yeah.
That's hard for markets.
I think the bottom line I'm saying is that, okay, this is short-term market choppiness. You understand volatility, but eventually the big issues that drive markets, like profits, interest rates, artificial intelligence being a game changer for what's going on, all that will eventually come through. If it wasn't there, I didn't think rates were going to fall, if I didn't think recession was probably unlikely, I'd be more worried. But I think that's probably something for 2026, 2027, but not right now. Thanks, Paul. That's Paul Rickard of the Switzer Report. And that's the show for this week. Thanks for joining us. Don't forget, if you want to be a subscriber to the Switzer Report, go to switzerreport.com.au. Thanks for joining us. See you next week.